Welcome back to Yahoo Finance. March started out strong for the housing market, but by the third week of the month, there were some signs out there that the coronavirus was disrupting the industry's momentum. So we had a new report out by Realtor.com, and it found that the number of newly listed properties dropped by 13% in the third week of March and dropped by 34% by the final week. So here to talk more about this and the implications that could have for the housing sector, we have Tim Rood, a former Fannie Mae executive, and also SitusAMC managing director. And Tim, thanks so much for taking the time this afternoon. There's lots to talk about here just in terms of how coronavirus is already impacting the housing sector. But I first want to start with the fact that the fundamentals for housing leading into this crisis were relatively strong. It was pretty bullish. Where do we stand at this point?
Yeah, hi, Seana. No, I would say it was very bullish going into the crisis. Up till the end of February, every proxy you would have for the health of the housing market, both residential, multifamily, new construction, existing homes, they were all very bullish. And they were supported in large part by huge tailwinds coming from the millennial population that was coming of age, low interest rates, everything was in its favor. Right now, what you're looking at is, of course, is a huge unknown. If you're in the market to buy a house, of course, it's a confidence game, not in the pejorative sense, right? But it's not only about affordability, but you also want to make sure that you've got great confidence in terms of your ability to continue to make the payment and your prospects for employment in the future. Those things have all really hit the skids. Nobody really knows how to kind of anticipate how long or how deep this crisis is going to be. And as a result, you're going to see activity on the refinance side as the Fed has come in and driven interest rates down, but there's a good healthy pause on the purchase side of the house.
Tim, what about the degree of the disruption? Because I know you were saying that at this point it's hard to tell, but how do you think that will vary across the country?
Well, it's taken a couple different forms. If you think about the CARES Act had a provision in there for one, foreclosure prevention, a moratorium for 60 days, and the other one had a large-scale forbearance program. And the impact of that is it was a very pleasant surprise for homeowners who were anxious about their prospects for being able to make their mortgage payments. However, it was less of a welcome surprise for the guys who actually have to advance the payments on behalf of the borrowers when they don't actually make those payments. And those are largely independent mortgage companies that are servicing, most of these government-backed mortgages. And as a result, it's going to impact the price of credit and the access to credit because there was never any facility. Heck, the independent mortgage companies weren't even consulted during the drafting of the provision in the CARES Act that requires them to advance these payments on behalf of the borrowers. So they were unprepared for that. And also the liquidity requirements for advancing 20, 30% of the market, which is what we're at risk of looking at, is overwhelming. It's 6 to 20 times higher than the statutory requirements that those organizations have of these independent mortgage companies. So that'll flow through in terms of both the cost of capital and the access to capital as mortgage companies, originators, servicers are finding themselves dealing with the financial and operational demands of a high refinance market now with an influx of borrower calls looking to investigate whether or not they actually qualify for forbearance.
Tim, how worrisome is that just in terms of the ability to handle this type of situation, the number of the forbearance claims that are being taken out at this point? Do you think that the stimulus package could create, I don't want to say chaos, but severely disrupt the mortgage industry just in terms of its ability to follow through on a lot of these claims?
Yeah, I'd say it already has, unfortunately, as a result of them having no liquidity facility for these independent mortgage companies that are having to advance what looks to be at a rate of maybe $10 billion a month, depending on the uptick rate. In 9 months, you're looking at $90, $100 billion of advances. Without that liquidity facility, then you're putting at great risk these companies that really, through no fault of their own, are really trying to implement the government's public policy. They are, in fact, the tools of public policy. So it's had a huge impact on those organizations, and we're going to wait and see exactly how that plays out. I think the other opportunity or the other challenge is any loan that's not guaranteed by the federal government, which leading into the crisis, at about 80% of the market was government backed. Now it's about 95% backed. And the result of that is, or the reason that is because anything that doesn't have a government guarantee, including prime jumbos or what they call non-QM loans, which ultimately have a variety of different proxies for creditworthiness and capacity that they use to document those things, that market has shut down. So now you've taken all this extra capacity out of the marketplace, and you've put the whole market, on the back of the government. And now the government is relying on these independent mortgage companies who, because they don't have an advanced facility, I can't tell if it's Russian roulette or if it's the Salem witch projects or something, but the government seems to be content. They'll see this play out. And if you lose some independence along the way, then I guess we'll figure that out when it happens. But the contagion risk of that in terms of the broader financial institution is somewhere between New Century or Lehman Brothers. And I guess we're just going to have to wait and figure that out.
Hey, Tim, I want to step away just from the policy measures that we've seen put into place and talk about what could be done or maybe what would alleviate some of the stress that's happening in the housing market right now. And a lot of that has to do with the technology, companies that are using technology in order to sell homes or list homes at this point. How effective do you think that is in a time like this? And how much pain do you think that would help alleviate from the sector?
Apparently not much. No, those iBuyer programs have gotten crucified. So they're not doing very well. In a robust market, I think that they had a place where they could pick off, the types of properties that people are so comfortable buying, right? It doesn't work very well. I mean, you think about real estate transactions, there's markets where you really don't need a real estate agent. There's other markets where you desperately need a real estate agent. And the iBuyers market, the ones that you're referring to, are really in the more frothy markets where you can do your research online, you can browse the properties online, and it's easy to make a determination in terms of the value of those properties and the trajectory of those values. In a harder market, you're going to need the personal touch of a realtor. And I think that definitely, puts a shadow on those businesses for the time being. And you've seen those iBuyers really retrench and pull from the market. And it's anybody's guess. It's ultimately how long this timeout is. It looks like, most disasters, you compare this to a hurricane or some other natural disaster, these things tend to go dark for the mortgage business and home sales for a period of months, weeks. In this case, it's really difficult to tell. And it's going to be a reflection of how strong the economy bounces back, how deep the unemployment recession is. And it'll be market to market. You're already seeing that in some of the states that have been hit the hardest. You've got Washington, California, New York, Illinois, Louisiana. Those markets you can already see in terms of the number of applications, the number of home sales, the number of listings have all fallen off the face of the earth.
All right, Tim Rood, lots of great stuff right there. Former Fannie Mae executive and SitusAMC managing director. Thanks for joining us.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.